Walmart Inc. ticker symbol WMT is currently trading at $90.81 a share. If we look at the stock over the last year, you can see it's up almost 52%, even with a recent decrease from its all-time highs at $105 a share. Also, if we look at the stock over the last 5 years, you can see it's up 106%. If we were to compare against the S&P 500 over a similar time period, it is easily beating the market. So let's go to my automated stock valuation spreadsheet and put in the ticker WMT, and this will load up all the latest company financial data so we can have a deeper dive. We'll be looking at the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value to see if there's a buy or a sell. Check out my Patreon if you're interested. So as I said before, Walmart, $90.83 a share, market cap of $730 billion, PE ratio of 37.5, which is higher than the market average, which is currently under 27. Earnings per share, $2.41, and a beta of 0.69, meaning it is less volatile than the market. And analysts do have it at a buy at $106 a share. It does pay a dividend, 0.99%, which is around about, well, not around about, it is 90 cents per share. They pay $7.2 billion in dividend, and in terms of the net income payout ratio and the free cash flow payout ratio, it is 37 and 56% respectively. Buy before the 9th of May if you want to get paid your dividend, and if you've missed on that, then obviously buy. If you can buy any time after that, within the next 3 months, you'll get paid the quarterly dividend. So ex-dividend date, if you can buy on the 9th, which I believe is when this video is coming out, you will be able to get paid your quarterly dividend. So let's have a look at revenues. All-time highs. Look at the most recent year, not the trailing 12 months. It is $680.99 billion, which is all-time highs, as I said. You can see here, steady increase every single time, and have continued to do so. Now, if we do look at Walmart's most recent earnings, this is the income statement here, we have 23, 24, 25. Split between net sales, membership, and other income. We'll just talk about membership. It is a small piece of the pie, 5.4 to 5.45 to 6.4. Now, yes, this is increasing very steadily, but their main thing, obviously, at Walmart is the net sales, the selling of their goods, and that is increasing as well. 605, 642, and 647. So everything is increasing, which is excellent to see. Are they generating more profit? Yes, they are. All-time highs, 19.44. So they're increasing their revenues and increasing their margins as well, which is very important for a company like this. Free cash flow, not all-time highs, 12.66 billion. Down from last year and down from their all-time highs, which was 21. But if we do look at operating cash flow versus CapEx, you can see operating cash flow is pretty much all-time highs, but the CapEx is massive. So if they were to decrease the capital expenditure spending, then obviously free cash flow would increase. Shares outstanding, they're buying back shares. They always have, and they're going to continue to do so, which is rewarding shareholders. So let's have a look at the discounted free cash flow model. This is a way of valuing stocks, looking at the discounted free cash flow. This is a way of valuing stocks, looking at the future free cash flows and discounting to today's value. So it currently gives us $63 a share. Let's see if we agree with this. Let me just overwrite the averages. $55 a share. Okay, that's much worse. So let's have a look at revenues. We're expecting 707 and 734 in the coming years. And that is pretty much where analysts have it. So we're going to keep that as it is. And then we'll have a look at those margins. Now, they are increasing their margins. Now, if they, let's just say a bit more of a bullish case, they can keep on increasing those margins. Brings us to $68 a share. But if we look here, net income to free cash flow, I mean, they have been decreasing. So if it's, somewhere in the region of 65%, it's $44 a share. Now, if we go back to that sheet, say they were bringing their capex down to 21 levels, which is here. So say that was somewhere in the region of 180%, it would be a big buy. So yeah, discount free cash flow model doesn't like it currently because of their big capex spending. Therefore, their free cash flow is down. But yeah, I wouldn't say it's a buy according to the model, because you can see here the free cash flow rate is very high, and even on the averages as well. So they need to lower that capex, and they are generating lots of operating cash flow, but the free cash flow not so much. Dividend discount model. You can see here they've played around with their dividend. They historically grew at about 2%. Not really a buy according to the dividend discount model. Ben Graham formula for intrinsic value. I don't think he's going to like the stock. But let's have a look here. We're expecting, about 12% growth. which we already have here. I see $40 a share, so not a buy there. So finally, let's have a look at the comparable company model. This is the way of valuing stocks, looking at their competitors. We've been looking at revenue growth rates, EBITDA net income, profit margins, price to sales, price to book, Peter Lynch's PEG, which is his price to earnings growth model. And then the specific metrics that go into the model is EV to revenue, EV to EBITDA, PE, and forward PE. So some companies that I do think we can compare it to, TGT, which is of course Target Corporation. I think they're probably their closest linked in terms of the ones we're going to compare it to. Next is Costco Wholesale Corporation, ticker symbol COST. And then we will look at, we'll also look at Amazon, but I'm going to do Kroger initially, ticker symbol KR. And let's see what it thinks. Obviously, Amazon, big with their component is AWS, which will generate all their profits, but in terms of their revenues, they are an e-commerce business. Anyway, enterprise value. Let me just, enterprise value. Walmart is the largest. Then Costco, then Target, then Kroger. Oh, Kroger, then Target, sorry. Revenues. Let me just switch these around, actually. We'll just go cost. And then we'll put Target there because I want to compare specifically Costco and WMT. So revenue growth rates. Walmart is about 6%. The other companies are higher. But on the 1 year growth rate, you can see they're pretty much neck and neck. Target and Kroger are down. Costco and Walmart are about the same with 5%. EBITDA. Walmart is the highest. Net income, Walmart is the highest. Profit margins, middle of the road. Price to sales, close to 1. Price to book, middle of the road. And PEG as well. Ideally, you want this under 1, but none of them are. EV to revenue, higher than the average. EV to EBITDA, higher than the average. PE, higher than the average. Forward PE, higher than the average. Puts it at $78 a share. So according to all these, not really a buy. If we look at Costco specifically, it does look like it is a buy, $121 a share, because all the metrics are, it is lower. So compared to Costco, it could be a buy. Then we'll just put in Amazon, or looks like a buy, sorry. Now we'll look at Amazon specifically, and we'll just compare the three, which is Amazon, Costco, and Walmart. And with those metrics, it does look like a buy as well. So compared to Kroger and Target, not so much, but Amazon and Costco, and specifically Costco, it does look like a buy. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check out my Patreon. And like and subscribe and all that fun stuff. I'll catch you guys next time.